The car market right now is bizarre. Prices are high, interest rates are brutal, and yet somehow demand hasn't fallen off a cliff. But the reason demand is holding up has less to do with affordability and more to do with who's actually buying.
The data says it all. You go back to 2019 and look at the percentage of sales for vehicles under 40,000 and over 60,000. Look at what's switched in the last 6 years.
In fact, the top 10% of Americans now account for roughly half of all consumer spending. Now, that's obviously not just cars, but it explains a lot about why certain dealerships are still moving units, while middle and lower class buyers are being priced out. A few months ago, I made a video saying that the car market was on the verge of collapse. Maybe it was a bit dramatic, but the trends were real, and they certainly still are. Earlier in the year, auto sales had slowed after a wave of panic buying from people trying to beat Trump's auto tariffs. Once those tariffs went into effect, everyone expected prices to climb, and analysts were waiting for the other shoe to drop. Fast forward to now, and some of those hikes are here, but still uneven across brands, as no one wants to be the first one to blink.
They're either spread out across multiple vehicles or they're put in different places that don't look like the retail price went up that much.
Brian Moody of Kelley Blue Book says there might have been a slight increase in the destination fee, a change in the offered interest rate, or absorbed by the manufacturer altogether.
Automakers who are absorbing the costs can only do that for so long.
In some cases, they're adjusting cost across all of their cars, spreading the tariff cost even to cars built here that are not subject to the tariffs.
Cox Automotive just raised its 2025 sales forecast to 16.1 million vehicles, up from 15.6 that was earlier in the year. Now that's only a slight increase from last year's 16 million units sold, and Cox admits that the bump is mostly from buyers once again rushing to get ahead of feared price hikes. And meanwhile, the largest seller of used vehicles, CarMax, just posted one of its worst quarters ever. So let's break down how the market really looks and what might be coming next. For the past 2 years, new car sales have been driven by the top end of the market. Automakers leaned into pushing higher margin SUVs, trucks, and luxury trims because they could get away with it. And it worked for a while. Wealthier buyers with cash or little debt didn't blink at $60,000 plus price tags. Now let me clarify. It wasn't just the wealthy buyers holding up the market. Plenty of everyday people still went out and bought cars, some of which they couldn't really afford. But the pandemic only made this dynamic worse. See, when chips were in short supply, automakers prioritized the most profitable trims and cut back on cheaper entry-level models. At the same time, used cars weren't depreciating like they normally would. In fact, some models even appreciated in value. And that helped create a distorted market. Affordable models essentially vanished, and dealers zeroed in on maximizing profits. The average transaction price for a new car shot past $47,000. Now, for most Americans, that's not sustainable. When nearly half of households can't cover a $400 emergency expense, asking them to finance a $50,000 car at 7% interest is just flat out delusional. But if you want to see where the cracks are really beginning to show, look no further than CarMax. On paper, they're the biggest used car retailer in America, but in reality, they've built a business around overpriced used cars and financing that borders on predatory. Their latest quarter made that crystal clear. The stock dropped 20% after earnings. With revenue down 6% and net income down 28%, they ended up selling fewer cars, and their finance arm is under serious pressure. The average interest rate on loans they wrote was over 11%, and delinquencies are rising. CarMax had to increase provisions for loan losses, which is a fancy way of saying more customers aren't paying their loans. Now, a big part of this comes down to how they structure their financing. CarMax runs its own in-house lending operation, often with rates that are flat out insane, like sometimes with rates that are over 20%. Now, used car loans are always pricier because lenders see more risk. The car's already depreciated some, it's going to keep losing value faster, and if you stop paying, the bank doesn't want to be stuck reselling a 10-year-old Nissan Altima that's out of warranty and will be sold at an auction for a loss. So CarMax leans heavily into this playbook and makes it even more punishing for buyers, and this is their core problem in my eyes. They rely on moving high-priced used cars with easy credit. But now that the cars are still expensive and the credit is getting tighter, the defaults are beginning to creep up. Their so-called no-haggle pricing is also hilarious branding, because what it really means is they're overcharging on both the car and the loan. Like, how are they going to set a vehicle's price way above market value and say, hey, we did you a favor, look, there's no haggle pricing? This is just another component as to why they had a terrible quarter. On the earnings call, CarMax announced $150 million in cost cuts, and their CEO said, quote, "The consumer has been distressed for a little while. I think there's some angst, and that consumers with better credit profiles seem to be sitting on the sidelines." Now, this is quite telling in my eyes, and it goes to show just how fragile their whole operation really is. My thoughts are people who have better credit have better options, or at the very least, understand just how bad the value proposition is at CarMax. But to be clear, CarMax isn't the only one feeling this pain. Auto loan delinquencies across the country are climbing fast, especially in the subprime segment. We're now at the highest level of missed payments since the aftermath of the 2008 financial crisis. That shouldn't really be that surprising, though, when we really think about it. Cars are more expensive than ever, loan terms have stretched to as high as 8 years, and interest rates are still elevated. You've got people taking out $35,000 loans on used cars at double-digit interest rates and then acting shocked when they can't keep up with the payments. But what's even more surprising is how little scrutiny most lenders actually apply to an auto loan. See, unlike a mortgage where they comb through your finances, auto loans often get rubber stamped. Dealers want to move the car, lenders want their interest, and nobody's really looking that hard at if a borrower can actually handle the debt. So while wealthier buyers still can afford to play in the new car market, middle and lower income Americans are drowning in the used car market. And once you're underwater on a loan, you're basically stuck because you can't trade in, you often can't refinance, and lenders now know that. Then as more loans go bad, they tighten standards, which means fewer people can then qualify for financing. And that's when this cycle really gets to be pretty bad. More negative equity leads to tighter credit. Tighter credit means fewer approvals, and fewer approvals mean fewer sales. Then the pressure rolls downhill to dealers and automakers, who then in turn respond with layoffs and cost cuts. But I think here's the biggest thing that can't be ignored. Cars aren't optional for most Americans. You need one to get to work or to just function in daily life. So when people start defaulting on auto loans at this pace, I think it's a sign of a broader financial stress that has been bleeding into every part of the economy. I'm not saying the sky's falling, but it should ring some alarm bells. So what happens next? Well, honestly, probably not much, at least not right away, especially if these tariffs stay in effect, which I guess we have to assume that they will.
The Trump administration hopes to incentivize more domestic production, but that will take time.
You're talking 2 to 3 year cycle. So we're going to do major damage to the economy and the consumer.
You're a longtime supporter of President Trump.
Yes.
What are your thoughts on how he's handling tariffs, particularly in the auto industry?
Well, listen, if I were to sit at the table with him today, I would ask him to reconsider his position, and I would say that he needs to do this with a carrot and not a stick.
As I've said before on this channel, even the most American-made cars still rely on hundreds, if not thousands of parts that are now subject to tariffs. And these are parts that simply aren't going to be made in America. That means cost won't come down anytime soon. Sure, it'll definitely vary brand by brand and model by model, but across the board, prices are going up or at best sticking at these high levels. Eventually, though, there has to be a breaking point. The people rolling negative equity into another used car are already upside down, and it's going to be devastating. You're locked into this loan where you owe more money than the car is worth. Your credit takes a hit if you fall behind, and you can't just get rid of the car because you still need it to get to work. It's a trap that can follow people for years, and the more it happens, the more it drags the entire market down with it. Wealthier buyers will still keep driving demand for luxury vehicles, which in turn will allow automakers to see how far they can push price hikes. But right now, in my opinion, the car market is basically a house of cards. It's standing because wealthy buyers are still spending. But underneath, you've got drastically overpriced vehicles, predatory financing, and tariffs raising costs even higher. CarMax struggles are just the canary in the coal mine, a warning sign that the current model isn't sustainable. Unless something changes, then the auto market isn't going to improve for lower and middle class Americans. And honestly, I think that if more buyers just went in with a clear game plan when they were going to buy a car, like researched the car they wanted, understood the pricing, looked at the financing, tried to get pre-approved before they got to the dealer, and then once they got to the dealer, were willing to say no to markups and add-ons. If more buyers did that, then the industry would be forced to change almost overnight. But until that happens, people will keep getting fleeced, distracted by the new shiny car, only to realize later they've signed up for years of debt they can't escape. Now, if you enjoyed this video and you want to learn more about why grocery prices aren't coming down, well, I covered it in this video here. Please check it out next. Thanks for watching.